Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 24th, 2024. I hope you're doing well. I hope you're having a good weekend. I appreciate you tuning into my weekend review podcast. To start off, here's a picture of my dog Sky. I know I've been including all these pictures of my trip to Colombia, but I really like these pictures. I just want to share them. But here's Sky right here with the sunglasses, and then here is a picture of my girlfriend and I at a restaurant. Look at this view. Isn't that just something? I'm really enjoying Colombia and Santa Marta. If you get a chance ever to come down here, please do. I think you'll like it. It's so laid back, and it's just a wonderful, beautiful place with beautiful weather, beautiful water. The people are very nice, very kind. And it's just a different world, and it's a good world. But anyway, in this podcast, what we are going to do, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all of my trades. We're going to talk about when I entered them, why I entered them, what the strategy was that I was using to enter, and most importantly, how I am going to manage the trade going forward, either to the upside or to the downside. I don't know which way it's going to go, but I have to know exactly what I am going to do regardless of what the market does. I've been trading for 28 years, and I've just got to tell you, the one thing you have to have is you have to have a process. You have to have if-then statements. If the price does this, then I'm going to do that. If the price does that, I'm going to do this. But you have to know exactly what you are going to do. And ideally, in trading, the key is you're going to have many losses, but you have to do everything in your power to keep those losses small by using a good risk-reward ratio before you get into the trade. So you can have large wins or completely allowed. Obviously, small wins are fine. Break-even trades, fine. Small losses, fine. You just have to keep away from the large losses, and you have to design a process that helps you do that. And what I'm going to show you today in my trades is I'm going to show you how I do that. And that is basically, looking for a key level to be rejected, entering the trade, position sizing based upon the volatility of the market, and then having a very good risk to reward ratio, or in other words, if it goes down even a little bit and loses that level, then you just get out for a small loss, but you have the potential to the upside for a large trade. So we'll talk about when I entered the trade, why I entered trade, how I'm going to manage the trade going forward. And then a little later in the podcast, I'm going to just talk about the market in general. We'll look at some of the indexes, we'll look at bonds, and I'll give you my thoughts on the levels that we're at now. Spoiler alert, I do think we are very near a top here, and I'll kind of make my case and explain to you why that is. After we go through the trades, we're going to talk a little bit about trader psychology. Most important skill in trading is the ability to create a plan and follow it. So it always helps me to teach trading psychology, and I hope it is helpful for you as well. And I have a good one to talk about. After that, I have gone down through my watch list, and I have identified some actually really good trades potentially for next week, both on the daily charts and the weekly charts. They're not where they need to be. These markets are not where they need to be yet. But if they get there, as I was going through last night and looking for what I was going to include on the podcast today and for my trades next week, I thought to myself, well, there are a lot of good trades here, a lot of potential good trades. So stay tuned for that, and I'll explain what I'm looking for, what levels I'm looking for to be rejected, and there's a lot of confluences of things going on as well. All right, so before we get started, we have to run this U.S. legal disclaimer, so let's get this out of the way. I'll be back in about 40 seconds. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast here, and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started. First of all, we're going to talk about the daily trades, and this is UNH, United Healthcare Group, and I did enter UNH back here on the 1st of February, and first of all, why did I enter here? Well, take a look at the black line. The black line is the 200-day moving average. Is there something magic about this line? There's really not, but there are a lot of people, there are a lot of eyes on this level. The 200-day moving average is a level. And what I'm looking for in a lot of my deep dip buy trades, and this strategy here where I entered UNH was a deep dip buy strategy. Coming down to the 200, the 300, or the 250, or the 30 RSI as well. But this particular one, I was keying off of the 200-day moving average. You can see a couple days before that, we were under the 200. The next day, we jumped up pretty high above the 200. This would have been a legitimate trade, but it's a little far away from the 200. So I wanted to see if we'd get a pullback, which we did. And I entered here on the 1st of February at 506.56 because during the day we bounced right at the 200 and then closed above. I always base my trades on the closing price. So now I have the support of the 200-day below me. That's the key. Now I have to position size correctly, and let's talk about that quickly. And it's quite simple, the formula, the math formula. So when I'm position sizing, or in other words, deciding on how many shares I'm going to buy, it depends on two things. It depends on how much money I have that I'm trading, and it depends on the value of the average true range, or the 2 ATR, 2 times the average daily range. Right now, it is 1562. So what I do, let's just take a hypothetical $100,000 trading account. 1% of that is $1,000. If you have $50,000, 1% of that is 500, right? If you have $1 million, 1% is 10,000. So 100,000 times 1% is $1,000. Then I divide that $1,000 by the value of the average true range 2, or the 2 ATR. So divide that by 1562. That tells me, for a $100,000 account, to buy 64 shares. Okay, so I see the bounce at the 200, the closing bounce at the 200-day moving average. I position size for a $100,000 trading account. It tells me to buy 64 shares. And then the next step is I place my emergency stop exactly 1562 below my entry. So if I have 64 shares and it moves $15.62, remember we just did the math, I would lose $1,000, 1% of my account. But luckily that only happens about 5% of the time. The other 95% of the time, if I have a loss, it's going to be an end of day loss. The line down here, 2 ATRs below, that's my emergency loss. My end of day stop is simply going to be a rejection of why I took the trade in the first place. I took the trade in the first place because it rejected the 200-day moving average. Therefore, in the future, if it closed below the black line, I would simply get out for a small loss. Make sense? So now I have an orange line up here. What is that? That is my 1.5 ATR trailing stop level. If I get to this line, then I'm going to start tightening up my stop to protect some of my profits, okay, but only when it gets to 1.5. So bounce at the 200-day moving average, I position size, enter the trade, I place my emergency stop 2 ATRs below, my end of day stops close below the 200-day moving average, my trailing stop level is 1.5 ATRs above. Everything I've just talked about is a defensive move, but as with any great sports team, you need to play offense and defense. So what is the offensive part? The offensive part is taking partial profits while it is moving my way. And the way that I do that is I simply take the closing price. Right now, the closing price is 527.24. So 527.24, and I add whatever the value of the 0.45 is to it. Right now, the 0.45 is $3.51. So I take the closing price, add the current 0.45 ATR value to it, plus 351. On Monday, my first profit target will be 530.75. Then I take my first profit target, add the value to it again, 351. Second profit target's 534.26. Take the second, add it to it again, 3.51. My third profit target's going to be 537.77. So on Monday, if it goes up, hits my first profit target, how many shares am I going to take off? It's very simple. I just take off 10% of the shares that I have remaining. So if it hits the second profit target, another 10%. If it hits the third profit target, another 10%. So that way we are scaling out of our position as the market is going our way. Yes, it reduces our position size, but we lock those profits in, and then if we do get a big move down, it mitigates our loss. So here we go. Why I took the trade: bounce at the 200-day moving average, position size, place my emergency stop 2 ATRs below. My end-of-day stop's a close below the 200-day moving average. My trailing stop level is 1.5 ATRs above. So I buy here, 506.56. Next day it goes up a little bit. Next day comes down, almost closes below the 200, but doesn't. Next day moves up, takes some partial profits. Next day moves up, takes some partial profits. Then we had a little bit of a down move. Then the next day here we gapped up, went much, much higher. Sold some position up here because it's 0.45 ATRs 3 times from the previous day's close. So it bounced up, took some profit targets, came right back down, moved up, profit target, a couple of days sideways, moved up, profit target, and yesterday moved up a little, but no profit target. Now we are to 58.67 RSI. So I have many rules when it comes to exiting using the 65 RSI level, the 70 RSI level, and how to approach it and to get fully out of the trade when it gets up there. So right now we're at 58.67. If it gets to a 65 RSI level, then the 5 EMA will come into play. The 5 EMA is this thin blue line here. And if it closes below that 5 EMA after reaching 65 RSI, which we're not there yet, then I would fully exit the trade. If we reject the 70 RSI level, I would sell half of my position. If I get a close below a previous bar's low after rejecting the 75 or the 70 RSI, then I am completely out of the trade. I know it sounds like a lot of rules, but they're really not hard, and I guess this is a good time to mention I do teach private one-on-one lessons in the evening time via Skype. I teach it's a one-on-one course, just one-on-one. It's the best way to learn anything. I teach you step by step all 5 of the different trading approaches that I use. Of course, right now on this particular trade, we're just talking about the deep dip buy, but I teach deep dip buy, moving average crossovers, return to value V1s, V2s, higher low V1s, V2s, double bottoms, bullish divergences. So it's a really great course. I've taught people from all over the world for many years, from beginners all the way up to the hedge fund level. So if you're interested, it's a great skill to learn. I've been trading for 28 years. I've been through every single market, and I love to teach. I really do love to teach, and I know you'll be a better trader if you take this class. So if you're interested, my email is in the link of the description, and I'll talk a little bit more about the course near the end of the podcast. So right now, all of my process and my rules are just telling me to stay in the trade. By the way, we did get to trailing stop level here. And right now, I am just looking for a close under a previous bar's low to get out of half. But this trade doing very well from entry to current price, up about 3.86%. So that's UNH with a deep dip buy. IWM. All right, IWM is a position that I took on Friday, yesterday, a short position. So what am I seeing here? Well, or what did I see here to help me make this trade? You notice the two bars here that I highlighted in blue. This is called an this is called an island reversal. These are some of my favorite new setups, island reversals and abandoned babies. If you like, I have a free video on my YouTube channel called Why Abandoned Babies and Island Reversals are some of my favorite new setups. But in this case, a island reversal, you see the big bar up here, see the prior bar, see how we gapped up? So we gapped up overnight. Why? I don't know. Right? There was just a lot of enthusiasm. The sentiment for this particular index, the IWM, the Russell, was very high and we gapped up. The next day we had an inside bar, we moved sideways, and then the next day we gapped down. So you see the gap to the left here and the gap to the right here. This leaves this kind of floating up here in space, these two bars, this island reversal. I have noticed on island reversals and abandoned babies, when this happens, the chances of this going much higher are actually quite low. And so one of the key points after the island reversal happens is if you get back up and close this gap, or in other words, get back up to the bottom of the island reversal, that is a very good place to short, or to go buy, or to get long if it's a bullish island reversal or abandoned baby. But this is a bearish one. So we gapped up, sentiment very strong, we gapped down, and you can see yesterday I got short here as we got right up to the bottom of that level, went a little higher, and then moved back down. So now when I trade island reversals or abandoned babies, I make it quite simple. I don't phase out. I basically have a stop, the red line up here, 2 ATRs above, and I have a profit target 4 ATRs below. So I'm either, this trade is just going to go on and it's either going to hit my stop to the upside or it's going to hit my profit target to the downside. And the key is your stop compared to your profit target should be lower on the stop and higher on the profit target. That's why 2 ATRs above my entry is my stop. 4 ATRs, or twice my accepted loss to the downside, is my profit. So this one's going to be quite easy. I like to intersperse different approaches. And you know, I'm hands-on with a lot of the other approaches, but with abandoned babies, island reversals, it's either going to be I lose 2 ATRs, or I make 4 ATRs. So this trade could go on for quite a long time. But so far, this trade is doing well, even just from Friday, up 0.4%. Okay, so that's IWM. And I just entered that yesterday. All right, let's go to Microsoft. Another short that I took on Microsoft yesterday. Why would I do such a thing? Well, now this is a little bit of a complicated trade. There are two things going on here. You see this high bar here, this tall up bar, that is called an order block. An order block is your highest close before you change market structure. We change market structure here. This is going to be a very difficult level to get over. Once you have a high like this, you break to the downside, you change market structure to the downside. It doesn't look like the market structure has changed at the downside, but technically it still is. Also, we have a fair value gap. What is a fair value gap? Well, a fair value gap is when you have a high, you have a pullback, you make a higher high, which we did here, and then you move down and you take out the first swing low. This also changes market structure. So there are two, and then the fair value gap is the gap from here to here that was never filled. So you have a high, pullback, higher high, change market structure. You have two very strong levels to get above. Now we still could get above them, but we came into the value gap. And then on Friday, we tested the low of this order block and rejected it. So this particular trade, I got in a little early. I was just waiting for the bottom of this order block. And I did this at first thing in the morning. On these, I don't have to wait until the end of the day. Abandoned babies, island reversals, and fair value gaps, and order blocks, I did right away, and I shorted the high. I shorted right at the open. And why? Because we got to the bottom of this order block and also in the fair value gap. So this was a very good trade for me on Friday. I shorted the absolute high right here at 415.50. So in this case, I position size correctly. I have my end of day stop, which is a close over this order block. If we close over the order block, then it changes the whole dynamics in the trade. My trade idea will be disproven because now we'll make a higher high, and so it all goes away. So a close over this high in this order block here at 420, I will get out of the trade. And then, of course, I have my emergency stop 2 ATRs above. And so if it does get up there for whatever reason, of course, I'll lose 1%, right? But my end of day stop is just a close over the order block. Now I place my, because this is a short, I place my 1.5 ATR trailing stop level below my entry. And you can see we're not quite there yet, but pretty good start. And if I get here, then if I have a close above a previous day's high, because this is short, I will exit half. So this particular trade, very, very good trade right off the bat on Friday, up 1.25%. It looks like it's doing pretty well. Hey, by the way, if you're enjoying the podcast and you're learning something today of value, I would appreciate it if you could hit the thumbs up button. Really does help out the channel. It's free, and it just lets YouTube know that you're finding something valuable in this particular podcast. So this short on Microsoft, already up 1.25%. Interesting trade. A lot of confluences of signals here. And in general, with trading, the best trades are the ones where you don't just have one signal, but you have many. You have a combination or a confluence of different signals, and we have different signals here. We have order blocks. We have fair value gaps here. We have a V1 to the downside, which is also indicative of us going down further. So we'll see. But the more confluences, combinations of indicators you have lining up, the better chance your chance of a successful trade. And again, this is what I teach in my one-on-one courses, not only on one time frame, but on multiple time frames. So that's Microsoft. AGQ I did take on Friday. You know, I usually talk about not taking too many trades on the same day. These signals were so good. And AGQ is silver. It's double leveraged silver, so it's a little outside of the regular stock markets. Okay, I entered AGQ on Friday at 24.73. This is a really, really good setup. This is a different strategy that I teach in my one-on-one course. This is called a return to value V1 or V2. This one in particular is a V1. Let's start with the green lines. Top green line, bottom green line. Anywhere in here is called the value zone. In general, I like to buy pullbacks in the value zone, sell above the value zone. Or I like to buy deep dip buys below the value zone and possibly exit them in the value zone. Most people like to buy up here because the news is very, very good. This is not the place to buy up here. Yes, sometimes they keep going. They really do. But most of the time they do not. Most of the time people buy here and get stopped out here, exactly the place that they probably should be buying. So we have the value zone. We closed above the value zone. We came into the value zone. We look for some sideways motion, which we got here, just some stabilization of prices, and then we got a V1 entry trigger. A V1 entry trigger consists of two bars, bar one, bar two. Bar two goes below, washes out, or in other words, goes below bar one's low, closes above bar one's close. This is called a V1. I entered here Friday, 24.73, which is exactly where it is right now. I position size. I place my emergency stop 2 ATRs below. As always, on a V1 or a V2, your end of day stop is a close below halfway of the washout bar. In the V1, the entry bar is the washout bar and the entry all in one. So that's why I have this line here about 24.41. It's halfway of this bar. If in the future we close below this line, I'm simply going to get out of the trade. Okay, if it stays above here and continues to move up, then of course I'll take my partial profits until we get to trailing stop level. And then here, if I get a close below a previous bar's low, I go into trailing stop mode. If we get up to the 65 RSI level, then the 5 EMA comes into play. If we reject the 70, I'm going to get out of half, and so forth and so on, right? All of the rules. Now, on Microsoft, I talked about a structure change, a bearish structure change. Well, now on AGQ, we have a bullish structure change. Look, here we have a low. We rally. We make a lower low, did we not? And then we move up strongly. We go above this first swing high here. This changes AGQ into a bullish market structure. Now, if we come back into the gap, which I've highlighted in blue here, this is a buy area. But in addition to having the buy area, I also had the return to value V1. So not only did we come into the bullish value gap and bounce, but we also had on top of that another standalone strategy, which is the return to value V1. So this is a very good trade. Multiple confluences of signals lining up here. It doesn't mean it's going to be a positive trade, but if I'm not going to take this trade, I don't know which trade I would. All right. So again, I bought it right at the close, right at the price, so completely break even on the trade. My end of day stop is a close below halfway at this bar. My emergency stop is down here. All right, so is that it for, yeah, that is it. So quick recap on the dailies. UNH up 3.86%. IWM that I took on Friday up 0.4%. Microsoft, the short that I took on Friday, up 1.25%. And AGQ, completely break even that I took on Friday. All right, now let's go over to the weekly bars. These are trades that I take on Friday because that is the end of the bars on weeklies. I like to trade multiple time frames. And let's talk about XLF. All right, I have been in XLF a long time. And what does that mean? If I'm in a trade a long time, it means that it is positive. Most of the trades, I have many losing trades, but the losing trades, I'm generally out of very quickly, and my winning trades I'm in much longer time, and that's what proper trading is. Being patient with your winners, being very impatient with your losers. And you're going to have losing trades. You're going to have a ton of them, but you have to get out of them quickly, and then you have to have a process to stay in your winning trades. So I have been in this trade nearly a year, if you can believe it. And this is a deep dip buy strategy that I bought back here on the 24th of March. Why? Deep dip buy. In a deep dip buy, remember, we use the black line, the 200, the purple line, the 250, the orange line, the 300-day moving average, or the 30 RSI. Those all have to do with deep dip buys. So here on 24th of March, that particular week, we came down, we went slightly below the 250, and close back above. That was my entry signal. So I position size correctly. I placed my emergency stop 2 ATRs below. And what is my end of week stop? My end of week stop is the opposite of why I took the trade. We took the trade because of the rejection of the 250. Therefore, in the future, if it closes below the 250, I'm simply out, right? I placed my 1.5 ATR trailing stop level above, which I did. And then each week, if it moves up the value of 0.45 ATRs, I'll take some profits. So anyway, entry signal here, 30.71. Next week, moved up, took some profits. Next week, sideways. Next week, moved up, took some profits. Now I'm in trailing stop mode. That means if I get a close below previous bar's low, I'm going to get out of half. A month went by here of just consolidation, really nothing. Moved up a little, and then here on the 23rd of June was the first close below the previous bar's low. I locked in half of the remaining shares I had for a gain of 6.4%, pretty good. Then we continued up for another 5 or 6 weeks where I continued to take profits off the table, reduced my position size, and then we had this big down move here. I thought I was going to get stopped out of my remaining shares here on the week of 10/27, but you see, we went below, closed above. Just that little close above kept me in the trade, thankfully, And then we moved up more profit targets, more profit targets, more profit targets, more profit targets, continuing to reduce and reduce and reduce my position size. And of course, we've just gone straight up or parabolic ever since then. We were up 64 cents this week, up 1.61. So I took another profit target off here. We're at a ridiculous 77.69 RSI. So the 5 EMA is in play. Also, if we lose the 70 RSI, I would take half. Then if I get a close below a previous bar's low after rejecting the 70, I would get out of another half. But this trade has been a monster. Not all trades are like this, but if you have a good process to stay in something, you will definitely be in something like this at one point. And this particular trade is up 23.71% on the remaining share. So it's been a monster trade. And the only way that I would have stayed in this really big trade is to have a good process. And whether you learn that from me or whether you learn it from someone else, it doesn't matter. But what does matter is that you do find a process that keeps your losses small and gives you the rules to stay in a trade until the rules tell you not to be in a trade. And if I can help you with that, please contact me. Like I said, I teach that in my one-on-one lessons. I would teach you a full process that involves many things, but they're all based upon good, solid technical analysis and good, solid trading rules. So, okay, so up 23.71% on XLF. Johnson & Johnson, another long trade on the weeklies. Let's talk about why I bought Johnson & Johnson. Wait a minute. Switching charts around here. Here we go. Okay, I did buy Johnson & Johnson all the way back here on the 10th of, the 15th of December of last year. Why? Well, again, this is a deep dip buy based upon the 200-week moving average. This is the black line. On that particular week, we went below the 200-week, closed back above the 200-week. That was my entry signal. In addition to that, I had a V1. Bar 1, bar 2, bar 1 went below bar 1's low, closed above bar 1's close. I could also have a V2. And by the way, if you want to learn more about V1s, V2s, just go to my YouTube channel. I have a free video there, talks about V1, V2 entries. They're a big part of my trading. Really big part of my trading. They make any trade better if you have a V1 or a V2. So here in this particular instance, I had a confluence of signals. I had a intra-week rejection of the 200 and a V1. So I got long here, 154.27. I position size. I placed my emergency stop 2 ATRs below. My end of week stop, simply a close below the 200-day moving average. I placed my 1.5 ATR trailing stop level up here. And of course, if it moves up the value of 0.45 ATRs, I take a portion of my position off. Next week, stayed above the 200, but no profit targets. Next week, stayed above the 200, but no profit targets. The next week, moved up. Nice big up bar, was enough of a move for me to take some of the position off. The next week moved up again, not enough to take profit targets, but I did get to trailing stop level. So now I'm in trailing stop mode, which means if I have a close below a previous bar's low, I get out of half. 2 weeks later, that did happen, where I have a close below a previous bar's low. I locked in half the position for a gain of 3.33%. Then the next 3 weeks we came down, but we did close above the 200. Had we closed below it, I would have gotten out. And of course, this was a really big week. I did hit 2 profit targets on this. You can see the value of the 0.45 ATR is 2.36. It went up 5.29, so I hit 2 profit targets. And the remaining shares on this particular trade currently up 4.5%. So nice trade there. All right. Not all trades are positive. This one was kind of a disappointment for me because of the big rally that we had in tech. And this was a really good position and a really good setup. Again, this is a return to value V2 Here's the value zone. We were above the value zone. We pulled back into the value zone. We moved sideways. We had a trigger here, a V2 trigger. I got long here at 33.41. I actually really had a lot of confidence in this trade, but it just didn't work. I'm not sure why, but sometimes they don't work. So I got long here, 33.41. Next week, we moved up a little and stayed above halfway of the washout bar, the close, but then this week it just went down. You can see here we closed below halfway of the washout bar. I had to get out for a loss of 7.01%, which sounds like a lot, but was it 7.01% of my capital? No, of course not, because when I got in the trade, remember I position sized correctly that in the worst case scenario, that if we got down to the emergency stop, I would have lost 1% of my capital, right? Well, we didn't even get down half of that, probably 0.35% of capital, but nonetheless, this was a losing trade. I'm not patient with losing trades, so I immediately got out for a loss of 7.01%. So recap on the weeklies, XLF on the weekly, remaining shares up 23.71%, Johnson & Johnson remaining shares up 4.5%, and Unity Software loss of 7.01%. So we have 1, 2, 3, 4, 5, 6, 7 trades, 6 positive, 1 negative, and so that's pretty good, right? You're not always going to bat 100%. You're really not. But the key again is on those losing trades, keeping them small relative to your the capital in your account percentage wise, and the winning trades having a process to let them run and to let them flourish. All right, let's get into a little trader psychology before we start looking at next week's potential trades. This is from Peter Robbins. You can follow Peter Robbins on Twitter or X at PR Robbins. Peter Robbins was highlighted in the Unknown Market Wizards. And to be in that book, you have to be a really good trader. So I would think that anything Peter Robbins would say to us would probably be worthwhile listening to. And let's see what Peter has to say today. The market facilitates the movements of funds from the accounts of the unprepared and the inexperienced to the accounts of the professionals. So what is this saying? Basically, the market facilitates inexperienced people's money to professional traders' accounts. And how do they do that, right? That's the real question. Unprepared and inexperienced. So unprepared meaning that you are not looking at your charts, you're not identifying levels, you're not putting in the work. And I would say you're not getting out when you're supposed to get out. And inexperienced to the account of professionals. Well, how does inexperience factor into this? First thing that comes to my mind, buying way above the value zone, right? Buying in locations that do not give you an edge to give you a better risk to reward ratio, or an edge that it's more likely to go up if you're bullish than it is to down. You really do need to prepare every day for the markets. I go through my charts every single day. The night before the next trading day, I identify all potential levels that I am looking for. It takes work. It's not just, you're just hitting a few buttons every day. It takes work. You really do have to study it, just like being a surgeon, just like being an attorney or an engineer. It takes work. It's not an easy way to make money. It's really not. It affords you a lot of freedom. Here I am in Santa Marta, Colombia. I could trade from anywhere, but I still have to work here, even though it's beautiful and relaxed here. I still have to work every day. And so, think to yourself, are you putting in the work into your trading, or are you just haphazardly buying something? If you're in a losing trade, you're just hoping that it's going to come back. That comes from inexperience and unprepared. Are you putting in the work to mark your levels? Are you checking on your charts? Are you checking on everything? Don't be lazy about it. But Peter is true. The market facilitates the movement of funds from accounts of unprepared and inexperienced to the account of the professionals, or in other words, from the accounts of the unprofessional to the professionals. And professionals work hard. They identify levels. They're looking at their charts. They do the work every day. They get out when they're supposed to get out. They don't hold on to losing trades. They don't quickly get out of winning trades, because you have to hold on to winning trades. You have to risk open profits in order to make more profits, and it's difficult. So if you're going to be a trader, treat it as a real profession, treat it as a real job, even if you have another job, but take it serious and follow good trading principles, which really means being patient, waiting for the markets that you're looking for to get some kind of level and reject it, and then having a process to get out quickly if you're wrong, having a process to stay in if you are right. So anyway, hopefully that was helpful for you. Thank you, Peter Robbins. And please follow Peter Robbins at PR Robbins over on Twitter. All right. So we're going to take a look at some potential trades for next week. There will be different approaches that I use here, the different strategies that I use, and the different strategies that I teach. It doesn't mean that if all of these trigger next week, I'm going to get into every single one of them. Ideally, I like to narrow it down to the very best one of the day or the week. And what do I mean by the best one? The one that has the most confluence of signals, the one that has the best risk to reward ratio, the one that's strongest relative to the rest of the market, the ones that look the ones that are also have confirming support or signals on the higher time frames. Those are the, it's basically like a report card. All of these could trigger all at the same time, but I'm most likely only going to buy one of them that has the best report card, that has the best score. Risk to reward ratio, confluences of signals, relative market strength, multiple time frames. And again, this is what I teach in my one-on-one course. So if you're interested, please send me an email. Love to talk to you. It's really a great course, and I teach you all 5 of the different trading approaches that I use, and I think the best way to learn anything is one-on-one with your instructor, and that is why I do this instead of teaching an entire class, because you're going to have questions. I have a lot of curveballs that I throw at you, because before you're done with this course, I need to know that you know exactly the rules and that you are trading correctly, and whether that takes 5 lessons, I've taught 7 lessons at some point because they didn't quite have it yet, but I'm not going to let you go until you know. All right, let's start with Apple on the dailies. All right, so in general, Apple is a good buy with the rejection at the 200. You don't get it coming down to the 200 a lot, but currently Apple is under the 200-day moving average. Apple's been weak compared to the rest of the market. I did buy it back here on the 15th of February because of the intraday rejection of the 200. Thought that was a good entry point, but I was wrong. Next day it closed right down below. So what did I do? I quickly got out. I'm going to have a lot of losing trades, but they're going to be quick, and this was just a one day I'm in, I'm out. I'm going to wait for it to come back at least over the 200-day moving average, or I'm going to have it come down to the next level, which is the 250. Maybe buy it there, test it there. Maybe it works, maybe it doesn't. But on Thursday, we did close back above the 200-day moving average. I didn't buy it. I did not buy it. And why? A couple of reasons. One, it was a little high over the 200, and 2, there was no confluence of signal, like if this had been a V1 or a V2 and closed above the 200-day moving average, or we had gone under 30, over 30, and closed back over the 200, I certainly would have entered the trade. But it still is a valid trade. It still would have been a valid trade. But like I said, looking for those confluences and combinations of indicators on multiple time frames really helps your batting average when it comes to having profitable trades. So I decided to skip Apple. Now on Friday, it was down 1%, and it closed back under the 200-day moving average. Going forward, however, if we close above the 200-day moving average again, I will, and just close over the 200 again, I would most likely take the trade, and the reason is it would come from a higher low. Here we make a lower low and close back over the 200. So we have a lower low, close back over the 200. Still valid. But in my experience, higher low closes above the 200 or better. So if on Monday, for example, we closed above the 200, this low back up, if we close above on Monday, then this low, when it was below the 200, is higher than this low. And so higher low closes, whether they're in the value zone, whether they from the 30 RSI, the 300-day moving average, the 250, or the 200, help improve the potential of having a profitable trade. So going forward, next week, if we close above the 200-day moving average, I will certainly consider buying Apple. Conversely, if we move down further, this 250-day moving average down here would be, if we, of course, we'll go lower, but I'm not against buying a lower low, especially on Apple at the 250 days. So it has to go higher or lower, either above the 200, which would give us a higher low close above the 200-day moving average, or lower to the 250-day moving average and or the 30 RSI. And like I mentioned a little while ago, a confluence of a rejection of the 30 RSI and a 250-day moving average on something like Apple would be a very, very good risk to reward ratio. So either higher above the 200 or lower, rejecting the 250. Berkshire Hathaway. Okay, well, Berkshire Hathaway has been on a tear, and I highlighted this in blue. Why? We have the potential on Monday for an abandoned baby. Thursday, we gapped up. Correct. Monday, if we gap down below yesterday's close, we will have a legitimate abandoned baby. We'll have a gap up and a gap down. And these abandoned babies are very good at identifying major tops, major bottoms. If you look at Berkshire right now, it's an 84 RSI. So just in general, just logically, you would think that this would be going down soon. But you can't just get in based upon nothing other than you think it's going to go down. I think it's going to go down, but I have to wait for a signal. And the signal simply would be if we gap down on Monday, and based upon the futures, that is likely, this may be quite a short-term or intermediate-term top. So I'm considering shorting BRKB if we gap down, making this a legitimate abandoned baby. And how would I handle this as far as my profit and losses? Probably very simply, 2 ATR stop above, 4 ATR profit target below. Cameco, CCJ. Okay, CCJ obviously has been in a downtrend, but we are coming to some important levels. The 200-day moving average certainly as an important level for a deep dip buy. We're at 31.54 RSI. We could conceivably on Monday go below 30 and above 30. Doesn't mean I would buy that just solely based upon that. Probably not. Probably not, unless maybe it had a V1 associated with it, something like that. That would push me a little more towards entering the trade. But the ideal trade next week on CCJ is if it moves down slowly and gets the 200-day moving average the same time it's at a 30 RSI, because one of the strongest signals you can take is an under 30, over 30 at the same time, and under the 200, over the 200. And that goes for 250 and 300 as well. So I'm just going to have to see how this plays out, look for the price action to tell me. But an under 30, over 30, really the only way I'm going to take this, because it's just one signal, is if it would come in conjunction with the V1 or a V2, which then doesn't make it one signal, it makes it two, right? So an under 30, over 30 next week with the V1 or a V2, I would consider getting long. Also consider buying with the rejection of the 200-day moving average as well. Intel. Okay, so this is a different approach that I teach in my one-on-one course. This is called a higher low V1 or V2. It's not there yet. It's not even really close, but I could see that next week it would be potential. Here we have the value zone, the two green lines. We rally into the first requirement is that we close below the -1, which certainly we did. Number two, we have to come into the value zone, which certainly it did. Now we're pulling back, which is another requirement. Now I need a V1 or a V2, a higher low V1 or a V2. One of my favorite trading approaches, but it's theoretically possible on Monday that we could gap down and reverse back up, creating a higher low V1 or V2. Or Monday we could come down, wash out Friday's low, and then Tuesday close back above, giving us that higher low V1 or V2. MACD is green here, which is also, you don't have to have this for higher low V1 or V2, but it is nice to have. And so we'll see. So looking for a V1 or a V2 next week, but it has to be a higher low V1 or V2. The low is going to have to be higher than this low here. Rio Tinto. Okay, so Rio Tinto deals with mining, gold, this kind of thing as well. And I've noticed on the charts, gold, silver, well, I went long silver on Friday, but they are starting to strengthen. And I highlighted here in the blue what is called an island reversal. We gapped down, so sentiment was negative. We moved sideways, and then on Friday we gapped up. So we have a gap to the left here. We have a gap to the right here. This is a legitimate island reversal. We were up on Friday. We closed below the low, but anywhere from the high or the low at this island reversal is strong. It's a strong location. As a matter of fact, you could have bought this on Friday because it closed the gap of the island reversal. But to make things simple, I like how the 200-day moving average is here inside of the island reversal. So just to make it simple, if we come back down, test that 200 and reject it to the downside and close back above it, I would certainly take a shot at Rio, because just a rejection of the 200 by itself is legitimate, but contextually overlaying the strength of this level from this island reversal makes it an even stronger trade. UNG. All right, UNG is natural gas, and look at this chart. Just down, 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 down. And then we had this big move up on Wednesday. Well, this is, we have changed market structure to the upside. Look, here's a low. We have a little bit of a rally. We come lower. And then this is the first swing high after the run of liquidity or the move back down. And then we had this huge day up on Wednesday above this first swing high. This puts us into a bullish market structure. So we are now in a bullish market structure, but you don't want to chase something like this. You want to wait for a pullback into the fair value gap. Well, the fair value gap is the low of Thursday and the high of Tuesday. I've highlighted it here in blue. Right here, right now, was legitimate to buy UNG. But what I'm waiting for is I'm waiting for it to come back and fill the gap, the lower part of this fair value gap. This would be an excellent place to buy because it's a major pullback after market structure has changed to the upside. And if I do buy here, if it gets to 1496, what is that, about 25 cents below here? Certainly possible. Be an excellent place to buy because it's the bottom of the fair value gap, and my end of day stop would be very close. It would just be a close below this low here of 1456. So I really like this trade. I almost bought this on Friday. I decided not to because I bought some other positions more than I usually buy. But if we reject if we get to 1496 here on UNG, that will definitely be an entry for me. And then last but not least is USO, which is oil. We have the 200-day. We closed below, closed above. We had a nice little rally up here. On Friday, we did come down. If we go lower and reject the 200-day moving average, I would consider buying there. Ideally, though, I think the better spot is down here at the 250 or 300-day moving average. And the reason that I like the 300 the best, because it's right here at the 50-day moving average. And then if I go to the weekly charts, do you see how the 300-day moving average on the daily, I drew the line here, do you see how that dovetails halfway of this big up bar? There is some inherent Fibonacci support here halfway here on the weekly. So on the weekly, we have inherent support at 69.51. On the daily, that 69.51 is at two major levels, which is the 300-day moving average and the 50. So I really like that trade a lot. But if we have good price action around the 200, I'll consider it here. But for sure, if we come down and reject that 300-day moving average, most likely I would buy that. So real quick recap, everyone. Do this quickly. Apple, if we move up above the 200, I would consider buying it with a higher low close above the 200. If we move lower to the 250, I would certainly consider that as well. Berkshire Hathaway, looking to see if we gap down on Monday. If we gap down on Monday, then chances are there is a high in for Berkshire Hathaway, so I would short if this abandoned baby fulfills itself with the gap down. CCJ Cameco, ideally looking for a under 30, over 30 with a V1 or a V2, or a rejection of the 200. Intel, looking for a higher low V1 or V2. RIO, looking for a test of that 200 below. UNG, natural gas, just needs to go a little lower for me to buy here at 14.96, the bottom of the fair value gap. And then again, oil, possibly the 200-day moving average, but ideally the 300-day moving average because of all the confluences on multiple time frames there. All right, let's go to the weeklies. Okay, FXY on the weekly. By the way, weekly bars, right? They close on Friday, so I would make this decision on Friday. Well, you see the lows we had back here in November of last year. Obviously, we ran out of sellers here. That's why we moved up. If we move back down to this level, the market has a memory of those levels. Doesn't mean it has to stay there. But what I like about FXY is double bottoms, bullish divergences. Look at this huge nonstop move down in FXY, Japanese yen. You see how deep these red bars are? These are called MACD bars. They measure the momentum of the downward move. Very, very strong down. Then we had this huge rally in the yen. We turned to green. Now we've come all the way back down. If we can test the lows back in November, I can already tell that the depth of the MACD bars are going to be not as deep as over here. See how deep these are? If we come down, test this low, MACD bars are down, but they're not down as deep as here. It would show that the momentum of selling is slowing, and therefore, if you're running out of sellers, which that is what it's showing you, if you run out of sellers, the implication is that you will go higher. But even if we get and test these bottoms here, I'll still need a signal. What would the signal be in light that we have a double bottom bullish divergence? Under 30, over 30 ideally would be the best. Possibly a V1 or a V2, excluding the 30 RSI, would be best if they all happen together. But first and foremost, we need, for me to get interested in FXY, I need to go down and test this low, have this double bottom in place, and then look for some type of entry signal. V1, V2, under 30, over 30, ideally together, but it's not there yet. It's not there yet. So if it doesn't get there, I'm just going to pass on the trade. But if it does get down here, I think it would be a good buying opportunity with the right setup. All right, Tesla on the weekly. Okay. Tesla, obviously much weaker than the rest of the market. We did come down to this 250-week moving average, and it held really well. Could have bought it right here. I didn't buy it. Moved up. Then we went below and above with the V1. This would have been a decent entry signal. You'd be a little down on the trade had you taken that trade. But this came from a lower low rejection of the 250-week moving average. Right now, we're at 191.71. If we came back down and retested the 250 right here at about 183, so about 8 points lower, we would come back to test this 250-week moving average. In addition to that, we would be halfway of this V1 bar. There's going to be some inherent support, likely inherent support, right here, halfway of this bar. But you see how the 250-week moving average dovetails right with that level? That would be a very good confluence of signals here at that level. So looking for a rejection of the 250 next week. And then VIX. Okay, I've talked about VIX for a long time. There's some major divergences, MACD divergences, ATR divergences, RSI divergences going on VIX. VIX is a measure of volatility. Essentially, if the market goes up, VIX usually goes down. Not all the time, but usually. If the market goes down, VIX is probably going to go up. VIX is at almost historic lows here. And volatility doesn't go away. You can see we had this big move down, just straight down. Over the last month, we have kind of found a bottom, but I still need a trigger to get in the trade. We're at 28.14 RSI, just looking for a close above the 30 to get me into the trade. So those are the weeklies. Real quick recap. Weekly on the Japanese yen, looking for a double bottom bullish divergence with an under 30, over 30 V1 combination, ideally to get long. Tesla, looking for a retest of the 200-day or 250-day moving average, about 183. And VIX, of course, just looking for a close back over the 30 RSI. Okay, so at the beginning of the podcast, I talked about that I wanted to look at the markets in general, and let's kind of look at the major indexes, and let me give you my thoughts on those. Okay, so here are the cues, everyone. You know, I like to use trend lines. I really quite like them. They are quite accurate in some cases. And if you take the two highs we have on the cues back here in January, then we had another high here in February. If you draw that line out into the future, you can see that if we get back to that trend line, not for sure, but it is likely that we will find some resistance there. And that, I meed, we could certainly get back up there. You know, one thing that happened on Friday, which I found interesting, is we have the previous high back at 12/2 of February 12th of this year. Do you see how Thursday we got right to that high and rejected it? And then Friday we gapped up and back down. So we broke out, but it was a false breakout. It was a false breakout. It tried to get above that high, then collapse back into the base. That is a bit bearish. And in addition to that, look, if you look at these highs, look at the high here, we have tall green MACD. We have this high here, we have MACD, but not as tall. Now, even Thursday and Friday, we are higher here. Certainly on Friday, we were higher. No green bars whatsoever. No green bars whatsoever. If you look at the RSI level back here in January, it was very high. Now we're higher here. RSI is lower. So we have a bearish MACD divergence. We have a bearish RSI divergence. These are indications that this rally is running out of steam. Of course, on Thursday, we had NVIDIA and everything went crazy and so forth and so on. Or, Wednesday night. But don't let that fool you from what the technicals are telling you. The technicals, to me, are telling me that this rally is running out of steam, just based upon the indexes. Double tops, bearish MACD divergences, double tops, bearish RSI divergences, rejections of the high. These are all indications that we could be going down. And again, on this trend line, if you draw it out into time, even if we do continue up, I don't see us going more than probably 9 points maximum to the upside. And with these bearish divergences here, I think it's time that we potentially could have a pullback, even all the way back to this level here. And again, that's why I shorted Microsoft. That's why I shorted IWM. So that's the cues. Let's look over here on SPY. And you can see we have a high. We draw the trend line out to the second high, and coming out here in space, very likely you'll get a reaction around that trend line. So not a lot of upside on the SPY as well. And look, here we have the highs, green MACD bars, tall MACD bars. We pull back to red. Now we are higher, MACD bars not as tall, bearish divergence. So this is kind of concerning to me on the SPY and on the Qs. Let's take a look at bonds. I'm actually quite bullish on bonds at this point, and I'll show you why. Look at this abandoned baby. That's bearish. Gapped up, yay, yay, yay. Next day gapped down. What happened? I don't know, but we went from very enthusiastic about bonds to very bearish about bonds very quickly, and look what happened. That bearish abandoned baby was extremely accurate. But why am I bullish on bonds now? Well, the reason I'm bullish is because we've had a couple things happen here. We've had a bullish market structure change. We have a low, we had a rally, we had a lower low, but then on Friday, we took out the first swing high, which changed this into a bullish market structure. In addition, look, we have this trend line here that we jumped out over and changed structure. So when you change structure, you really need 3 bars. Well, you need this bar. We need one more bar, which will then show us where some fair value gaps are. In other words, what I'm saying is that we change market structure to the upside. I'm waiting for a bit of a pullback down, buying a dip in a market that has changed structure to the upside is one of the best risk to reward ratios you can get. Now, why are bonds going up? Are bonds going up because we feel like inflation's going down? Possibly. But bonds could also be going up because money is flowing out of the stock market and into bonds. Or in other words, people may be looking for a flight of safety. Based upon what I just told you about the bearish things that I see in the market, even though it's very strong, this could be early money leaving the stock market, rotating into bonds. So anyway, I hope that analysis there was helpful. Like I mentioned a couple times during the podcast today, I do teach private one-on-one lessons in the evening time. I love to teach. I teach a really good course, one-on-one, the best way to learn that. I've taught from absolute beginners all the way up to hedge funds and everywhere in between. So if you are interested in studying with me, if you're interested in learning to trade like I do and being able to do this all on your own, just send me an email. The email is in the link at the description. We can talk about the course. We can discuss any questions you have, about the format. But I know you're going to be a better trader. It's money very well spent. I promise you. The cost is $1,750, but it is worth every penny. And like I said, I've taught people from all over the world, from all different levels. And so if that's of interest to you, please write me. If you're not in the financial situation to be able to take the one-on-one course, I have a really good alternative. I have a video course where I teach you the deep dip buy stock trading approach on udemy.com. The link is in the description. It's a really good course. I think it has like 4.9 stars on the reviews, but it's very affordable, and that course is 26 videos, 9.5 hours of video total, and then 15 study guides. It's a really great place to start. Like I said, if you're not in the financial position to take the one-on-one. One-on-one's better because I teach you all 5. The deep dip buy is only 1, but it's very, very affordable on udemy.com. So if that's of interest, click the link, take the course, and I know you'll be very happy. Again, if you like today's podcast, I would appreciate if you could hit the thumbs up button. It really does help the podcast, really helps us out with YouTube. So if you found something helpful, if you could just hit the thumbs up button. But more important than anything, please try to go out and do something nice for someone today. If we all did one nice thing for another human being, it would make the world a lot better and nicer place, and we can do it. Let it start with you. And if I could ask one more favor, if you could do one nice thing for an animal as well. Animals appreciate acts of kindness just like we do. So if we could, I try to do one nice thing for another human being each day. I definitely try to do one nice thing for an animal each day, and try it out. It will help them, and I promise it will feel good. and be good for you as well. So I appreciate you being here. If you have any comments or questions, please leave them in the comments section. I'll do my best to get back to them. I'm trying to stay here in Columbia for another month because I like it so much. So send me a message and or send me any questions about questions of this podcast, and like I said, I'll get back to you. Okay, so God willing, I will see you next week, and I hope you enjoy the rest of your weekend. And thank you so much for spending your time. I hope it was helpful. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.